Okay, well thanks for surviving to morning 3. We've lost a few people I think, but there might be a few turning up. Here we go, as the time morning goes on. I finished yesterday was a very long lecture and I didn't quite get through all the slides. So the good news is I'm going to do those slides this morning. The bad news is it's going to force you to wake up straight away because there's some mathematics in them. Not a lot, but a bit. So last lecture I went through the pioneers and what I call a non-equilibrium approach to economics, which Marx is the first, without the labour theory of value, Schumpeter, Fisher, Keynes, and I went to start discussing Kalecki and Goodman, didn't quite get there, so I'm going to talk a bit about Kalecki and an idea called the principle of increasing risk that clearly played a part in how Minsky first attempted to bring finance into economic theory, and then go through a largely verbal explanation of Minsky's financial instability hypothesis. I'll just actually turn this recording on here as well. Okay. So, I mentioned Keynes Fisher talking about how over-indebtedness can lead to a depression. In some ways, Keynes explained how you can get there in the first place by expectations that become overblown during a boom. And Kalecki, was often people see somebody who invented most of the innovative work in Keynes' the more mathematical perspective before Keynes himself in many ways. And what Keynes talked about was the link between finance and real investment. And he used an idea he called the principle of increasing risk. So I'm going to explain that in a bit. And it involves rejecting a lot of neoclassical theory about what controls the amount of investment that people will do. Because the normal argument you'll get out of neoclassical theory is that firms will invest until the marginal return from the investment equals the marginal cost of borrowing the money. And there's an idea as you borrow more money to buy more machinery, the more machines you hire, the less productivity per machine, and that falling tendency is what cuts off investment and gives you equilibrium. Well, Kalecki said, well, let's consider an investor who's got capital little k. I should make that bold to make it more obvious that it's an amount. The amount of money k to invest, and you've got a return of income from that investment, which he calls eta, and you can then get a gross profit you're likely to earn, which is your gross profit is going to be the amount of capital you've installed multiplied by the return per unit of capital. Okay with that one? Okay. Well, the gain, then actually your net gain involves taking that gross gain and deducting what the market rate of return, because if you're not getting more than the market rate of return, why not put the money in the bank? And you've got to allow how risky that is as well, because you've got to take into account the fact you're not getting a guaranteed return, you're gambling on potential outcomes. So he said the net gain you're looking at is this gross gain minus the riskiness times the market return times the amount of capital you've actually decided to employ, which of course involves borrowing money to get there. So how do you get the maximum gain given the amount of capital you're going to hire? And you said, well, micro theory assumes that gain is a function of the amount of capital. The more capital you get, each unit of capital gives you more gain, gives you positive gain, but less gain than the previous unit of capital. The whole idea of diminishing marginal productivity, which is an essential concept in neoclassical theory. And there's therefore a single maximum. You simply find the point where the gain has fallen enough so that it matches the risk of the cost you have, and that gives you your amount to invest. That's where you stop investing. And this, because you've got a single maximum in the whole thing, where the second differential ends up being negative, where the first is zero, first differential is zero, you've found your maximum. So according to neoclassical theory, and that's fairly messy, I'll take you to the final part of it, you want this to be equal to zero to get your maximum profit. And by working through the mathematics, you finally say, well, there's your profit per unit of capital minus the riskiness and the market return, multiplied by plus the amount of capital given you've got a second a product rule effect going on here. You've got to set that to zero, and then the theory that says, well, that d pi dk is a declining number, And there's no relationship between the amount of capital and the interest rate you're paying or the risk you have. So they then say, well, therefore those two are equal to zero. So we can forget about those two. So your optimal neoclassical condition is this, that when you go through all the cancellations, and I know that's far too fast, certainly the first thing in the morning it's far too fast, but you can follow the logic if you look at the slides later. It says that you keep on going until the change in return per unit of capital is equal to the sum of the riskiness and the market rate of return. And that's how you decide how much to invest. So you keep on investing, which means you're borrowing money to do that investment because you've gone beyond your own monetary stocks potentially. You keep on doing it until the rate of change of return with respect to capital is equal to the sum of market return plus the risk premium. That's the conventional theory. Now, and that says, well, diseconomies apply. The more capital you have, you get diseconomies of scale coming in, you get less return per unit of capital, or there's imperfect competition, some sort of barrier that means you get a declining return rather than getting the same return indefinitely. Well, Kalecki said both those arguments don't make sense, empirically speaking. He said, first of all, yes, it's true that every machine has an optimum size. So if you're building a blast furnace, there's a certain point where the scale of the blast furnace itself gets to be just too big. He said, why not build another one of the same optimal scale? There's no reason to stop at one blast furnace. Okay, so there's the declining productivity per unit of capital doesn't make sense at that level. And he says you can put your money across a portfolio of industries. You don't have to be caught in one where you're getting monopolistic competition barriers or things like that. So he said that he reckons that d pi dk, the rate of return of capital, the rate of return per unit of capital, the change of that return, you can pretty much regard as a constant. It's not going to be the determining factor. So there's no effective non-monetary barrier to the amount of investment you would take on. You can't use this theory to say there's a physical barrier to the amount of investment you're going to undertake. He said instead, as you expand K, you've got to borrow more money. Once you go beyond your own retained earnings, you've got to borrow money to do the investing. And so for the more you would borrow, the more chance you are that something's going to go wrong. You might call this a black swan effect. The more extended you are, even if risk is a Gaussian type random thing, the more extended you are, the more likely something's going to happen that's going to be big enough to send you bankrupt. So what's going to stop you investing is that your cost, either you're going to be more likely to go under with an inopportune event occurring, or the person lending money to you is going to say, you're too extended, I'm going to charge you a high rate of interest. So what he said instead, what constrains it is that the rate of return you've got to pay to get that money is going to rise, or your riskiness is going to rise. And ultimately you're going to keep on investing until the return on that extra capital is equal to the rising risk you face and the rising cost of interest you have to pay. So it's that increasing risk and increasing interest costs are what restrain the level of profit, the level of investing that an individual capitalist and a collective capitalist class is going to undertake. So what he saw restraining investment wasn't the physical side of productivity, which is the usual neoclassical case, it's the monetary side. Okay? That's the main emphasis that Kalecki brought to the vision of how you link finance, the monetary side of capitalism, with the physical side of capitalism. So that gives you this link between finance and investment. So it's what limits the amount of investing a capitalist will undertake is not the physical productivity of the capital, it's the cost of financing that capital. And that's the link which brought Minsky into the picture, because that's where he began in trying to do his economics, trying to model as an economist. Now Keynes reached the same conclusion back in 1937, not mathematically, but verbally. So here's Keynes from one of the very, very good papers in 1937. Has anybody here read the General Theory? Okay, one. Has anybody tried to read the General Theory? You got a certain point you couldn't keep on going? Confusing, boring on occasions, what's he trying to say, etc., etc. I have that same attitude to it. I satirise it in one part of Debunking Economics, as I quote the section that Keynes actually describes in the section I quote as the essence of the General Theory. And you get to the end of it, and I said, "You got that?" And my basic answer was, "Come on, pull the other one." It's obtuse, boring, complicated, hard to work out what the hell he's talking about. And he calls it the essence. Now, I think what you see in the general theory is Keynes was actually in some ways attempting to build a Marshallian version of his theory. There were parts and ways he tried to bring the theory back into the fold of Marshall. Other times he's trying to move away. And you get this amalgam of the two. So there's equilibrium thinking in the general theory, and there's disequilibrium thinking. There's stuff which talks about marginal this and marginal that, and there's stuff talking about expectations and big gaps and so on. In 1937, when he had to defend the general theory against criticisms of all sorts, he actually became more and more away from Marshallian thought. And I think the 37 papers are shorter for a start. There's 3 or 4 of them, and much, much easier to understand. So if you couldn't comprehend the general theory, forget about it. Get the 1937 papers by Keynes, okay? Don't feel so bad about not being able to read the general theory. So, yeah.
My question, why is it that there is increase with capital? Because normally if you have more capital, you diversify your portfolio, so there's less risk. I don't understand very well that between
well, because you've got to, but if you're borrowing more money to do it, you're getting more highly levered. Okay, that's the basic point. It's the leverage that matters, and thanks for clarifying that. That is the issue. So again, here's the same sort of thing been said by Keynes, again verbally in his 1937 papers. It's not a lack of savings which inhibit investment, but a lack of finance consequent upon too great a press of uncompleted investment. Okay? So he's talking about finance limiting the growth of the economy, and you'll actually find him talking about, he had investment and savings as the 2 key factors in the general theory, but here he's saying he left out finance as a precursor. So there's Kalecki and Keynes are consistent on this front. I went to Hyman Minsky, and he, as I mentioned, his family were emigres from Russia who were Jewish Marxists, members of the Communist Party. He never once referred to Marx in any of his published works. For the obvious reason, he was writing during the McCarthy days in America. And even mentioning that you even looked at a copy of Das Kapital was enough to get you sacked from an American university. But definitely that was the background, and I'll give a little anecdote about that later. Schumpeter was his PhD supervisor, which I think was an absolutely brilliant combination, because the cyclical stuff I gave you a coverage of in yesterday's lecture was the foundation of the conversations that Minsky had with Schumpeter. And Keynes talking about 2 price levels. This comes actually quite late into Minsky's work. Minsky had developed most of his ideas before he'd read the general theory. A bit like you, if I'd asked this question and Minsky had been in the room, he wouldn't have put his hand up. He hadn't read the general theory until quite late in his writing, and he only read it after he read the General Theory of Employment, which was a very short paper written in 1937. So he was a late comer to reading Keynes as well. And then Fisher talking about debt deflation. That was part of Minsky's thesis all the way through. And Kalecki on the whole idea of principle of increasing risk. I'll take some of this water now. I'm starting to need it first thing in the morning. So he blended all those to give us what he called ultimately the financial instability hypothesis. So his parents met at a Communist Party function. That's why I said it's pretty hard to say he didn't read Marx. The anecdote that I have about that involves his son, who is a member of the INET community these days, the Institute for New Economic Thinking, runs an independent media service in San Francisco. And I met Alan back in 2000 when I was writing Debunking Economics. And we're chatting at the Levy Institute, which is where Hyman Minsky was based in his final years. And he said he rebelled against his father, as most children do. And then later in his career, in his early 30s, he decided he wanted to read economics now. He said, "Dad, what do you recommend as the first book I should read on economics?" He said, Dad went into the studio and came out and gave me this book and said, "This is the one you should read." It was volume 1 of Das Kapital. Okay. So clearly there's a foundation in Marx, but not the labour theory of value, as is obvious. So that's the early formative experiences come from that background. Then he was in the Second World War, and we did a degree in the post-war degree phase that the American army did, so if you had fought in the war, you could get to university education. But of course, he came out in the middle of the witch hunt days, so that you couldn't mention that you had any background in Marx whatsoever. Minsky is his supervisor, so Marx and Schumpeter were where he began. And very early on, he read Fisher's great debt deflation theory of Great Depressions. He had a degree in mathematics, and he attempted to build a model of the trade cycle by combining Hicks's model of the trade cycle with Kalecki's principle of increasing risk. That's why I took you through that painful bit to begin with. Now, Kalecki's argument was about the idea about investment being restrained by increasing risk as capital grows. And Minsky said, well, I can feed this into this conventional model of the trade cycle. And the model was that. Now it says output now is alpha plus beta, two constants or two parameters, multiplied by output the year before, minus beta, which is one of those two parameters, as you can see, times output the year before that. Now, I think I covered this briefly in this lecture, but that is actually a fallacious economic model. Most economists don't realise it, but it is not a model at all. But what Minsky accepted that as a model, as most economists did, and said, well, maybe if I make the beta component reflect the principle of increasing risk, I can get a trade cycle which is driven by finance. And he said beta would fall as the economy grows. That's the principle of increasing risk reducing beta, therefore giving a turning point to what in the model, if you actually ran it, depending on the parameter values you use, you got an explosive blow up in the level of output. So his argument here with what he called the accelerator component is based on the productivity of investment, but also the willingness to take on risk. So he said that will decline as you get a higher level of financing, so that'll give you a turning circle. Now, the model was useless. It went nowhere. He got his PhD writing that mathematical model. That was the basis of his PhD. He got a couple of publications in the American Economic Review out of it. The trouble about it is, this is one of the reasons economists need training by genuine mathematicians, not by bloody economists thinking they can teach mathematics. Okay, which I've been through both extremes. Because when you look at that equation, it was developed by Samuelson and by Hicks independently, and Hicks developed it as a reaction to Harrod talking about capitalism having a fundamental instability. And Hicks' argument was, well, a mathematically unstable system doesn't fluctuate. It just breaks down. Now that is wrong. That is true of a linear model, but only true of a linear model. It's not true of non-linear models, as I've shown you in the first lecture, and I'll show you in a bit more detail in tomorrow's lecture. So what did Hicks do? This is classic Hicks. He was writing a review, and then he said, well, because this is actually an important point, I'm going to go beyond a review and actually write my own model. That's precisely what he did to develop ISLM in the first place of Keynes. So what people took as Keynes was Hicks's ISLM, and what people took as the trade cycle, which was Harrod's contribution, became Hicks's mathematical reworking of Harrod's idea. So what Hicks did, said he took, first of all, when Harrod expressed his idea in mathematics, it was effectively in continuous time. So the first thing Hicks did was convert it into discrete form, where he said, this is the equation that Harrod had, and Hicks converted it to say, rather than G being the rate of growth, it was output now minus output the year before divided by output now. It should have actually been output the year before, but nonetheless that's what he did. And then he said, this investment part looks really queer. He said, it's not reasonable to assume that current investment depends upon the change in output in the same period, which is fair enough. So he then said, investment should depend upon the increment of income in the preceding period. So he's saying investment now should depend upon the change in output in the previous time period. But notice the next one. He said, and consumption upon the income of the preceding period. Now, how many of you consume today based on what you earned last year? Okay? Maybe last week, but not last year. This is one of the reasons I'm a critic of this discrete time modelling in economics. Even though we should be aware of those time differences, we don't do it. And a huge part of stock flow consistent modelling these days are models where everything depends on something that happened the previous year. Now that's conflating consumption cycles, which are much shorter, with investment cycle. That alone is a problem. But he then defined investment to be some constant multiplied by the change in output, by output in the previous year minus output in the year before. And then he had consumption also being based on income of the year before. The first obvious point at which you should object to the model. So he then said savings was therefore equal to income in this year minus 1 minus S, which is the savings ratio, times output the year before. And then he equated savings at time t to investment at time t, and what popped out was that equation. So when you rework the equation, you then said output this year is 1 minus S plus C multiplied by YT minus 1 minus C times YT minus 2. And now what you can see is that was the alpha component in the model that Minsky was working with, and that's the beta component. And beta relates to investment, which is why Minsky called it the accelerator. Well, what it generates is cycles without growth. Now, if I was giving a longer course, I'd go to this in more detail. But the equilibrium of that is 0. Okay? The equilibrium level of output in that model is 0. The only amount you can feed in that will not give you change over time is 0 output, which is a really useful model of a capitalist economy, isn't it? Something wrong there. The reason I say you should be taught by a mathematician how to do mathematical analysis rather than by an economist is every economics textbook I've seen and every course I've done, when they've analysed this model, has used what's called the characteristic equation. So you can convert that difference equation into a quadratic. And then you solve the quadratic. You find the roots of the quadratic, and that gives you a solution, and you feed that in and you get your values over time. What a mathematician would do is actually transform that into a matrix equation. I'll show you what that means. Again, this is a bit of an overview for you. I know this is going to cause a bit of what my friend Trun Andresen calls the Migo effect. My eyes glaze over, okay? So don't get freaked out by it. It's just giving you a bit of background here that if I did a longer course, I would take you through it and let you understand it. So you can convert a second order equation into 2 first order equations. That's the first stage. So I can divide, there's the equation in terms of t plus 2, t plus 1, and t itself. I've just added 2 to all the time steps there. That mess says, well, I'm going to find another variable I call x1, which is the first element in a vector. x1 and x2 are the two elements of a vector. And x1 at t is equal to y at t. So they're just the same thing. So x2 at t is going to be equal to x1 at t plus 1. So the two elements of the vector are related to each other. So x2 at t is equal to y at t plus 1. Then the next step again is say, well, x2 at t plus 1 is going to be equal to y at t plus 2, yada, yada, yada. Again, I'll take you through much more slowly. I'll let you get to do it yourself if I was teaching this with anything other than a crash course. So I can finally convert that equation up here into that. Those two equations, believe it or not, are identical. If you know your matrix mathematics, it's saying x1 at t, I'll show you if I can point it out here, x1 at t, which is y at t, which is over here, is going to be 1 times x2 at t. No, it'd be too complicated to try to do this live this early in the morning, so I won't try that trick. But that's the matrix. That's the matrix conversion of that model. So you can now, as a mathematician, you would say, what are the properties of that matrix? Now, one property for a valid model is that, see, notice what you've got here is saying x at time t, here, x at t plus 1 is a multiplied by x at time t. So what you want for a valid model is that you want x at t plus 1 and x at t to be non-zero. You want an outcome that says they can be amounts other than 0. So one essential reason, the way that can happen, is this matrix somehow itself has to be equivalent to 0. Meaning, if you know the number 0, what's the inverse of 0? There is no inverse to 0. Okay? You can't invert 0. Well, the same thing applies in a matrix. You want a matrix you can't invert. And that is the inverse of that matrix. So a mathematician would say, this is not a model. There's only one solution to this model, and that's that xt and xt plus 1 are all equal to 0. That's not a dynamic model at all. So the characteristic equation gives you fluctuations to reach the trivial outcome. The matrix method says that's not a model. There's something wrong with the logic there. Unfortunately, that's what Minsky tried to build his model on. So that's why I say you should learn, if you do mathematics, if you want to do mathematic modelling in economics, do a mathematics course. Don't go to a course taught by economists, teaching, even by me. So it's a useless model, what Minsky was trying to do, and that's why I certainly didn't try to build on what Minsky himself had done. So it went nowhere, but he kept on trying to say, well, how do I explore the implications of finance for economics? And he tried from a conventional understanding of Keynes, and this is why I made the point that just like many people in the room, he hadn't read Keynes in the original, he relied upon textbook versions of Keynes. And notice this one here, this is back in 1965. He says, if we make the Keynesian assumption that consumption demand is independent of interest rates, but assume investment demands depends upon interest rates, then a rising set of interest rates will lower the beta coefficient. Waffle, 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 but what he's really saying, investment is a function of the rate of interest, and only a function of the rate of interest. That is ISLM. Okay? What he thinks is Keynes is identical to ISLM. Now that went nowhere as well, but one day he read those papers in 1937, and the key one he read in 1968 called The General Theory of Employment. Now bear in mind this is about 10 years after he got his PhD. So Keynes came into his thinking very, very late in his development as an economist. And then the concepts which we now identify with Keynes from a post-Keynesian point of view, uncertainty and expectations, start to turn up in his theory. And that's why he called his first book John Maynard Keynes. It's not a biography. It's actually a very short book, about 140 pages. And if you want to read Minsky in the original and get a coherent overall statement, that's the book I'd recommend. Not Stabilising an Unstable Economy, which waffles on for 2 or 3 times the length and doesn't say much more, but John Maynard Keynes. So he read it, and he then said that this, what he thought was Keynesian, was actually far more Hicksian. And he says Keynes emphasises the importance of financial factors. And he said it's especially evident in his statements of what the general theory is about in his rebuttal to Weiner, which he wrote back in 1937. He said what Keynes emphasised there was the importance of uncertainty for determining what you do in the short run. And he says, my interpretation of Keynes is not the conventional view, which is mainly derived from Mr. Hicks's Mr. Keynes in the Classics, an article which I believe misses Keynes's point completely. Now, of course, what are we seeing 40 years later? We've got supposed Keynesian economists still seeing ISLM as the basis of Keynes. So that's one reason, again, that I fight as vigorously over the whole Paul Krugman thing, saying, look, what you call Keynes, well, Krugman spoke at the 75th anniversary of the General Theory in Cambridge last year. Actually, early this year, I think it was. And he made a strong point that, yes, there are people like me who argue that Keynes should be about Chapter 12, Chapter 17, and the 1937 papers, but he could also quite happily pull out quotes which are perfectly consistent with Hicks's ISLM out of the General Theory. So I think it's quite true. There are 2 branches you can go in. But the trouble is the economic profession went down the one they were familiar with. Whereas what Keynes in 37 starts to show, we should have gone a different way. And this is what Minsky brings together. Now when you look back in where Minsky was now looking into Keynes, back in Chapter 12 and Chapter 17 and the 1937 papers, you find this argument that rather than investment being controlled by the rate of interest, which is the Hicksian stuff, it's motivated by the desire to produce those assets of which the normal supply price is less than the demand price. And that's talking about 2 price levels. And who does that sound like to you after the last couple of lectures? It's more like Marx and like Marshall. The demand price, which is the price you're willing to pay to buy an investment good or perhaps to buy a share, is determined by the yield you expect to get, by depreciation and by your liquidity preference at the time. Where the supply side is set by the cost of production. So there are 2 price levels. And now I can find a commonality between Keynes and Marx in this way. That normal commodities are based on a markup on cost of production, whereas asset prices are set by your expectations of gain under uncertainty. 2 very, very different factors. And that two price level stuff became quite dominant in Keynes afterwards. I mean, I showed this one yesterday, but then again to point it out, in 36 he talks about marginal efficiency of investment, marginal returns, etc., etc. And then in one tiny part of chapter 17, I could even set it as an exercise for a class. Try to find where he said something different in chapter 17. It's really hard to find, but there is one sentence. But then 37 comes along, and bang, all he's talking about in terms of the gap between cost of production and the price you can realise them in the market given the expectations and uncertainty. And he then abandons this whole idea of the MEI, marginal efficiency of investment and marginal efficiency of capital, and talks about uncertainty and said, well, the essential thing about uncertainty is you can't reduce it to risk. You can't use probability here because there's simply no way of knowing. Now, what you then do, because you can't know the future, is you use presumptions. You know, in our hearts we know we can't know the future. Unless you're a neoclassical economist like De Breuer and co, you can't believe you can't lay out all the future states of the universe and work out what the probabilities are. Forget it. We don't do that. So we're aware of it. It's part of what makes us alive, that we're aware of the uncertainty of the future. But how do we handle it? First of all, we presume that what's happening now can be projected forward. And I think that's the fundamental way that I model expectations when I bring expectations into my mathematical models. We believe the existing prices of shares, prices of houses, asset prices and so on, are correct in terms of how they sum up future prospects, and we fall back upon the judgment of the crowd, which is perhaps better informed. Now that is an incredibly fragile basis for expectations. Anything can go wrong with those sorts of bases. But the trouble is, when people try to explain this, the concept of uncertainty is always described as not risk. It's a negative. So if you look at Keynes's explanation, he said it's not roulette. Okay? It's something like the price of oil in 20 years' time or that sort of thing. But I find none of these ways of explaining uncertainty actually get to people's souls. And I then had one of my students, still a good friend, Manchester Dye, give a presentation where her question was explain uncertainty. And she did this live, just it occurred to her. She said, imagine you're very attracted to someone. And this person has accepted invitations from 20% of the people who have asked them out on a date, he or she said yes to. Does that mean you've got a 1 in 5 chance of being successful if you ask them out on a date? Would you use probability in that case to decide to go and ask? No way, okay? Because we know that even though you might be able to work out the odds retrospectively, every aspect of attraction is an individual thing. And there's no way that what the person did in the past gives you any guide to how they're going to respond to you. That's uncertainty. Okay? That's real uncertainty. That's a positive example of it. So the response they're going to give you isn't a risk. It isn't like a toss a coin and 1 in 5 chance it'll come up yes. No, it's uncertain. And the fear of that is what's going to stop you doing something quite frequently. Well, the same thing with investments. The success or the failure of past investments is no guide to what's going to happen in the future. So how do we cope with relationship uncertainty? Well, we do all sorts of things. We try to find out beforehand. We ask their friends, We do nothing at all. We get paralysed into inaction. Or we ask regardless and take the risk. We're compelled by ourselves to have to make an action. Or we follow conventions. We go along to, the social convention, like going to parties and seeing what happens. What about investors? Same sort of thing. Without any way of knowing the future, you've got to form fragile expectations. You have to act. The way you act is crystallised in the prices you're willing to pay for capital assets. But of course they're subject to sudden and violent change. I think emotional relationships are a far better way of analogy to investment than any ideas about probability and so on. So the marginal efficiency of investment argument goes out the window with Keynes in his 1937 papers, because to have that marginal efficiency, you've got to be able to put a rate of return upon a stable denominator, which is the amount of capital you've invested. Now, how do you value the capital? If that value of capital is jumping up and down like crazy, you simply can't even talk in terms of a marginal change anymore. So he starts abandoning this entire approach. And Minsky says in 1969, having read Keynes for the very first time properly in 1968, that his ideas about uncertainty seem to be consistent with those of Keynes. So he brings all these elements together, Marx, Keynes, Fisher and Schumpeter in one, and he calls it the financial instability hypothesis. Now, given I've given you a heavy start for the morning, I think I've got about halfway through here. Let's take a coffee break, come back in about 10 and keep on going.